Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, May 6th, 2023. I hope you're doing well, and thank you so much for tuning into my weekend review podcast. Hope you had a good trading week. It was quite volatile, up and down. We had a big rally on Friday, so good for the bulls. And so here's the format for this weekend's podcast. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly charts. We're going to talk about when I bought them, why I entered the trade, and most importantly, how I am going to manage the trade going forward. When we're done with that, going to do a little segment on trader psychology. Always the most important skill in trading is the ability to create a plan using good trading principles and then follow through on that plan without letting gains or losses amplify your emotions and getting you out of your trade or making you not follow your process. And that all comes down to trader psychology. So most important skill, everyone, is what's going on in between your ears and following that process. It's always helpful for me to teach this, and I hope it's helpful for you to listen. After that, we're going to do a poem from my good friend Frank. He's the trading poet, always has great poems that he writes every day, very pertinent to what's going on at the moment, and always helpful for me. And I hope you appreciate his poems, and so we'll do that. After that, I have gone down through my watch list, both my master watch list, both on the daily and the weekly time frames, and I will go through and identify the trades that I'm looking for next week. When I do this, the price probably has to go down further to look for some kind of resistance, support, and rejection of some kind of key level, or sometimes it has to go up higher to get above some resistance levels and look for some momentum to the upside. When it comes to trading, generally for me, kind of what I look for is I look for levels. If we're talking about going down, I look for levels, key levels that get rejected. Once I find that rejection, then I have to decide how many shares I'm going to buy, and I have to base that my share size based upon the volatility of the market. And I have a really good formula that I use where I know exactly what my maximum allowed loss is, or for my emergency stop, I know where my if I lose that key level, then that's called my end of day stop. And so I always concentrate on risk first. Rejection of the key level, position size based upon the volatility of the market, placing my emergency stop, having my end of day stop. These are to if the risk first to the downside, and then to the upside. If it starts moving up, I always take partial profits when it moves a certain distance from the previous day's close. I'll go through that and explain that. And then if I get to a certain level, which is called my trailing stop level, which is 1.5 ATRs above my entry, then I go into trailing stop mode so that I don't give it all back. But I'll go through these. I'll show you exactly what I've done. Hope that's helpful for you, and doing that both on the daily and the weekly. But the key here is having patience for the market that we're looking at to get to that level. If it gets to that level, it all looks good, then I will take the trade. If it gives me a good risk to reward ratio, I will take the trade. And emergency stop, end of day stop, taking partial profits, trailing stop level. It's all very key. You have to play offense and defense in trading, and your emergency stops, your end of day stops, your defense, selling into strength when it goes your way. That's the offensive portion of my trading. All right, and so hopefully it will be helpful for you. I did take some trades last week. It was a really volatile week. Not the greatest week for me. Had some good trades as well, but not the greatest week for me. There was a lot of chop down and up, got me out of a couple of positions. But that's how trading goes, right? You don't always have great weeks. The key is have your rules, have your process, look for those levels, do everything you can do. But then once you put that trade on, then it's out of your hands. Then you don't have any control over it. But you do have control over your process. So regardless what a market does, I know exactly what I'm going to do. It's, having this plan, having this process is a much more holistic way to trade because you're not in control of it, but you are in control of whatever it does. You have to know exactly what you're going to do if it does this. If then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. And it's all based upon good trading principles of position sizing correctly, having a good risk to reward ratio. That's the profitable. That's the calculus of profitable trading. All right, doesn't always work out, but at the end of the year, if you have more winners than losers, and you're going to have losers, but if you have more winners than losers using these principles, that is what's going to get you the money, and that's how you make money trading. All right, so that is the plan for today. I do have to run the U.S. legal disclaimer, so hang tight for about 40 seconds, and I'll be right back. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get to my particular trades. Now, I do want to say at the outset here, in my opinion, how you manage the trade is the most important part of your trading. It's easy to get in if you see a level, but then how do you manage it from there? And I just want you to know that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught students from all over the world. It is very important to me that my students succeed. And in my course, I teach you the 5 different trading approaches that I use, all the rules that I use. And if you take this course, I know you're going to be happy. I know you're going to learn a lot. So here in this podcast, I do my best to show you my rules, but it may be a little confusing, and you might think, man, this guy has a lot of rules. And I do, because it is an important part to be successful in trading, is to have these rules. So if you are interested in potentially working with me one-on-one, the course that I teach is 15 hours. 5 sessions. Each session is 3 hours. It is a serious course, but you're going to learn a lot. I have taught people from, like I said, all over the world, both from beginners to actually even hedge fund managers. And so you'd be in good company. You're going to learn a lot. The price of the course is $1,750, but it's worth every penny. So if you're interested, my email is in the link in the description. Just reach out to me. Okay, so let's get started. Here is a trade that I took on Friday. Now, if you've been watching this podcast, you've seen me talk about waiting for LMT, Lockheed Martin, to get down to this key level. I was talking about it all the way up here, and I said, look, here is my key level. Here is the 200-day moving average. This is a key level. This is where large institutions and savvy investors will come in at this level. And it doesn't mean it's going to be a profitable trade, but it's an important level. You want to look for levels where you have a good idea that there's going to be some buyers there, right? And I wasn't interested in buying Lockheed Martin up here. I said, look, if it gets down and rejects the 200, that is where I'm going to enter. That gives me a good structure for this trade. The black line here, the 200 SMA, is my key level of support. And if it goes down and gets rejected and it's able to close back over that, that is where I'm going to take the trade. And that's exactly what I did. So on Thursday, this is called an intra-day rejection of the 200. During Thursday, we opened above it. We went below it, we tested all the levels below, and we closed right back above. And so that is the price action that showed me to enter this trade, the rejection of the 200-day moving average. So I mentioned earlier that once we see the rejection, like here, and I did get in here at 452.14, then I have to position size based upon the current market volatility. So let me show you that, how we do that, how I do that. This is all based upon your total capital. Let's just say you have a hypothetical $100,000 trading account. I take 1% of that, which is $1,000. If you have a $50,000 trading account, then 1% is 500. So hypothetical $100,000 trading account times 1% is $1,000. I take $1,000, I divide it by the value of the 2 ATR. ATR means average true range. That's what it's expected to move in any one day. I want to go twice that because I want to get outside of noise. So I take the 1% of the hypothetical $100,000 divided by the value of the 2 ATR, divided by 1667, tells me to buy 59.9 shares, right? Or I just rounded up to $60. So now, or 60 shares. So now I've bought 60 shares of LMT. Now, immediately upon buying, I go exactly 1667 below my entry. Okay, so if I have 60 shares and it moves 1667, how much have I lost? $1,000. That's my maximum allowed loss. Does that mean I'm going to lose $1,000 on every trade? No, far from. As a matter of fact, only about 5% of the time will you hit your emergency stop. 95% of the time, you're going to hit your end of day stop. And what is my end of day stop? Well, why did I take the trade? I took the trade because we rejected the 200. Therefore, on Monday, if it closes below this 200, then I'm simply going to get out. The emergency stop down here is the worst case scenario. And I do wait for the end of the day to make my trading decisions because at the end of the day, you have large financial institutions. I consider them the smartest money on the street. They come in, move the stock at the end of the day. So if it closes under the 200 on Monday, I will simply get out of the trade. If it's below the 200 during the day, I'm going to stay in there until the end because that closing price is the most valid. Now, like I said, all of my trade decisions are based upon the end of day close, except for my emergency stop. If Monday we go down and hit that emergency stop and I've lost that hypothetical $100,000, then I just get out of the trade. I don't care what time of the day, whether it's 1 minute after the market opens or 1 minute before it closes. If it gets down there, I cannot risk any more of that because I have determined that the $1,000, the 1% of my total capital, is the maximum allowed loss. Now, like I said, this does not happen very often. I have an example here on XLE where I did hit my emergency stop this week. Hasn't happened in a year, maybe a little bit less than a year. It doesn't happen very often, but it did happen. And so I did hit my maximum allowed loss, and I'll show you that when we get to XLE. Okay, so that's the setup. Rejection of the 200-day moving average, position size, place my emergency stop below. Now, I also put 1.5 ATR trailing stop level above. The emergency stop's 2 ATRs below. The trailing stop level is 1.5 ATRs, here it is right here, above my entry. If it moves up and gets to that level, now I go into trailing stop mode. And that's what I was mentioning before about the rules. And I do teach this in my course. But essentially, once we get to 1.5 ATR trailing stop level, if I have a close below a previous bar's low, I will exit half because once it moves 1.5 ATRs from there, it should not come back because you're 1.5 from your entry, you're outside of noise. But if I get to this level and then have a close below previous bar's low showing the potential of a reversal, I want to lock in half. I'll keep the other half, give it some breathing room, right? But again, if we close below the 200-day moving average, I am completely out of the trade. So just to recap, rejected the 200-day moving average, position size, place my emergency stop 2 ATRs below. If it closes below the 2 ATR, if it closes below the 200-day moving average, then I'm just simply out of the trade for a small loss. If it reaches 1.5 ATR trailing stop levels, now I go into trailing stop mode. If it continues to move up, I will take partial profits every time it moves the value of 0.45 ATRs. In this case, it's 375. So essentially, what I do is I take the closing price of today, 455.56. I'll add the value of the 0.45 on there, 375. That will be my first profit target on Monday. If it gets there, I will sell 10% of my position. I will also do a second and a third profit target essentially 455, 56 plus 375, whatever that is, that's my first profit target. I'll take the first profit target, add 375 to it again. That's my second. I'll take my second profit target, add 375 again. That is my third. And I just place those in the system as limit orders, and I don't even have to be around the computer. If they hit, they hit, and then I lock those profits in. The market can't take them away from me. I reduce my position size, so I'm reducing my entire risk on the trade. It's very important. So that's it. This particular trade was up on Friday, and so far up 0.8%. But the key was being patient, waiting for that key level to be rejected, and it was. That got me into the trade. Okay, AMD. Sorry, this is a little cluttery. I understand that. I did buy AMD back here on the 26th of April. Why? Well, my key level, and if you've listened to the podcast, I said, look, I need this to come down and reject the 300 SMA, and it did. Here on the 25th, it closed below, so that's not a key entry for me anymore. The next day, it closed back above the 300. That's the key level, right? So I position size, I place my emergency stop 2 ATRs below. Where's my end of day stop? Well, why did I take the trade? Because it closed over the 300. Therefore, if it just closed even a penny below the 300, I would get out of the trade. The next day opened up, went way down under my 300, but I didn't sell because I'm waiting for the close. Then it closed above, kept me in the trade. It did move 0.45 ATR, so I took some partial profits. Next day, moved up again, took some more partial profits. Next day, moved up again, took more partial profits. And then the next day, I got out of the trade, not because any of my signals told me to get out of the trade. It's simply that there were earnings, and I don't hold stocks or stock positions through earnings. It's too much of a gamble. Our role as traders, firstly and most importantly, is to manage risk, and holding through earnings is a great way to have a big move down. And yes, of course, you can have a big move up as well, but we are focused on the risk. A profitable trader and money manager, first thing, needs to focus on risk, not profit, and holding through earnings is a great way to lose a lot of money quickly. And so I did get out at the close before earnings for a 4.65% move. And then earnings came out. They were not good and immediately down. And I was so glad that I followed that rule. Now, ironically, they had some news and it rocketed back up. And it's all the way back to almost exactly where I sold this before earnings, ironically. But I didn't have to go through this emotional of taking a 10% hit and going, oh my gosh, what have I done? And then it moves up and moves up. But it did recover. But the key was I did not have to go through this by following my rule of getting out between earnings. So rejection of the 300, moved up, partial profits, exited the trade here prior to earnings for a 4.65% gain. UPS, oh, this one was frustrating. I had the right idea, but it didn't work. I did short UPS when we came, let's see, back here on the 28th, we went down, we came back up into the 200, inside this big bar to the left here. That was showing me that most likely that this rejection of the 200, that it would continue down. So I shorted here 180.11, position size correctly. In this case, place my emergency stops 2 ATRs above. My end of day stop is a close above the 200, and that's what it did the very next day. Had a loss of 1.13%. Had to get out of the trade because now we have support of the 200 below. And then, quite rude, then it went down my way. But that's trading, everyone. You're not going to make every, you're not going to have a win on every single position, and you have to follow your rules. Had I not followed my rules and not got out, yes, of course, I had made a nice little amount of money here, but it could have continued up as well. And then I would have been mad that I didn't follow my rules. See, that's the catch-22 of following your stops. A lot of the times you're going to get out of your stops. It's going to reverse back on you. It's going to go back up. You're like, oh, why did I take that loss? Gosh dang it. All I had to do was hold one more day. But there are times where getting out of that position, it continues down, continues down, continues down. And you would be so happy that you followed your stops. All right. It doesn't happen all the time, but there are those handful of trades where you can literally wreck your entire account. So follow your rules, follow your process. I know it's frustrating. This was frustrating because my bias on this trade was down, but I had to follow my rules and then down. But follow your rules. It's most important. So I did lose 1.13% on this UPS trade. Okay. XLE. Woof. Like I said, have not hit an emergency stop for quite some time, but I did, and I'll explain this to you. I did buy XLE back here with the rejection of the 200-day moving average. Bought it at 83.80 position size. My end-of-day stops closed below the 200-day moving average. My emergency stop is 2 ATRs below. Next day moved up. And this is a good example of why taking partial profits when you have them is a really good thing, because it moved up strongly, locked in 10% of my position size at profitable levels. So now I only have a 90% position size. So if it does move back down, I'm not going to lose as much because I took a part off, right? So got in here at 83.80. Next day moved up, took some profits off the table at profitable levels. Next day came down, held the 200, my end of day stop, and then the next day just had a big crunch down, and look, opened here all the way down, got to my emergency stop. I did not wait for the end of the day. As soon as it got there, took the loss. But was it $1,000 loss, the hypothetical $1,000 loss? No, it wasn't. It was less than that because I did take a portion off here at profitable levels. And I got out here, next couple days went down and down. I was like, oh boy, I am glad that I got out at my emergency stop. Then of course on Friday we had a rally, but it's actually still below. So a loss of 4.06%, pretty big loss on that one. But does that mean I lost 4% of my capital? No, of course not, because the maximum allowed loss that you can have using the position sizing of taking your maximum allowed loss divided by the value of the 2 ATR, that in the hypothetical of the $100,000 account, I would have lost only 1% of my total capital, even though it was a 4.06% loss. And like I said, it really wasn't a hypothetical $1,000 loss because I took a portion off here. But anyway, not all the trades work. You have to follow, but it's a good teaching example of hitting an emergency stop for a 4.06% loss. Caterpillar. All right, another frustrating one. I did enter Caterpillar here on the 2nd of May with this higher low rejection of the 200. You can see during the day we went below, closed above. This is a higher low than this. Really good setup. This one didn't work, but another good example of I entered here 214.60. My end of day stop is a close below the 200-day moving average. My emergency stop is 2 ATRs below. Entered here 214.60. Next day went up, hit a partial profit, reduced risk, locked in partials at a profitable level. And then Thursday we had that big down day, closed below the 200. Didn't hit my emergency stop, but closed below the 200, and I had to get out for a 1.98% loss. And then another example of getting out and then it moving back above. I could have taken this position here because it closed back above the 200 again, but I didn't. But this is a loss of 1.98%. IWM, I have been in this trade. Okay, these are weekly trades, by the way. Weekly trades, weekly bars expire on Friday. And so I wait for Friday to take the trade. I have been in this trade for a long time. Back in October 14th, 2022, Friday, it rejected the 300 SMA on the weekly. That is why I took the trade, right? So position size, emergency stop, 2 ATRs below, end of week stop, a close below the 300 SMA. Well, went my way, moved up, took profits, moved up, took profits, got to trailing stop level, which doesn't mean I sell. but it puts me into trailing stop mode, looking for a close below a previous bar's low. Next week went down. Next week up again, took more profits. I'm in trailing stop level, leveled off. Here on the 9th of December, had my first close below a previous bar's low. So that tells me to exit half the position, which I did, and it was a nice gain of 6.37%. Now I have half position, kept moving down. If it closed below the 300, I would have gotten up, but then we had this another huge big up move. So I always take partial profits when it moves up. No profits here. Here took off more of the position at highly profitable levels, right? Double-digit profitable levels. A couple weeks sideways. Then we have the high here. Took more off at these very, very high levels, right? So I'm continuing to reduce my risk and lock in profits. And then we had another leg down. You can see the 300 has held this level, and we have not closed below it. During the week, we did get below, but now we closed back above. So I do not have a lot of shares left because of the taking partial profits on these moves up and the trailing stop level here. But the shares that I do have left, from entry to exit, up 4.1%. All right, so that's IWM XLF. All right, XLF is the financial sector ETF. I bought this back on the 24th of March with the bounce at the 250-week moving average. I position size, placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. Next week, moved up, took some profits off the table. Next week, didn't do much. Next week, moved up, again, took more profits off the table. It got to my trailing stop level, which means now I'm in trailing stop mode, which means if I have a close below a previous bar's low, I get out. This week, I thought, oh, I'm going to hit my trailing stop level, but it did close above that previous bar's close. That kept me in the trade. So the remaining shares that I have so far on this particular trade, up 5.17%. So nice trade there. AGQ. All right, this was a short position on AGQ that I took back here on the 14th of April with the rejection of the 200 week moving average. I got short at 34.60. Position size, placed my emergency stop 2 ATRs below my end of week stop. In this case, is simply a close below the above the 200-day moving average, or 200-week moving average. Next week, moved down, took some partial profits off the table at profitable levels, reduced my position size, so therefore reduced my entire risk on the trade. And then Friday, man, we were way under, and then we had a huge rally back over. It did close above the 200, so I got out for a very small loss, 1.85% loss. But luckily, by taking the partial profits when the market gave them to me, I locked in some at profitable levels, so it reduced the ultimate loss on this trade. But the remaining shares that I did have, which was the majority, loss of 1.85%. Pfizer, new entry that I took on Friday. Why did I take this? Well, this is called a deep dip buy approach. During the week, we went under the 30 RSI, rejected it, and closed back above the 30 RSI. That is a deep dip buy approach, one of my very favorite ones. Let's go through this trade. I'll show you exactly. So hypothetical $100,000 account, 1% is $1,000. $1,000 divided by, what's the value of the 2 ATR? It's 359 divided by 359 tells me to buy 278.55 shares. I'll round that up to 279 shares. So rejection of the 30 RSI and the negative third ATR channel, confluence combination of indicators lining up there. That's why I took the trade. Entered at 38.44. Place my emergency stops 2 ATRs below. So if my 279 shares move 359, how much have I lost? $1,000, right? Is it likely it's going to get there? No, it's not likely. Only about a 5% chance. What the likely part if I have a loss on this trade, will simply be a close below the 30, because that's 30 RSI. That's why I took it. It went under the 30, closed back over 30. So therefore, next week, if it's below the 30 RSI, I will simply get out of the trade. All right, so I bought here at 380, 38.44. It's through 38.49, so slightly in the money on the trade, but that's how I decided to take this, because it rejected a key level of a 30 RSI. And by the way, I do teach the deep dip buy method in my private one-on-one courses. I teach you step by step. It's a great approach, one of my very favorites. And also, if you like the idea of these deep dip buys, I do sell a course online at udemy.com. The link's in the description. Costs $16. 12 to 15, $16. They change the price, I think, every day. But I sold so many of those around the world, got so much good feedback, so many good reviews, and deep dip buys are some of my favorites. So, if you're not in the financial position to take the private one-on-one course, you can buy that at udemy.com for $12 to $16, and you will learn a lot. So that's my new trade on Pfizer, and we'll see if it holds the 30 RSI. Great. If not, I'll get out, most likely for a small loss. If it moves up, hits my trailing stop level, then I go into trailing stop mode like I discussed before. So just a quick recap. LMT in the money 0.8% on the rejection of the 200 on the daily. AMD, nice 4.65% gain. With the rejection of the 300 out of the trade. UPS, this one did not work, had a loss of 1.13%. XLE hit the emergency stop loss of 4.06%, and Caterpillar loss of 1.98%. On the weekly here, IWM in the money 4.1%. XLF, rejection of the 250 in the money 5.17%. AGQ had a loss of 1.85%. Pfizer just took the trade on Friday, basically break even. All right, let's do a little trading psychology. As I mentioned, most important skill in trading, the ability to create a plan and follow the plan without letting the intraday or intra-week emotions get amplified and get you off track. This is from my friend Christopher M. Uhl, CMA. You can follow Christopher at 10 Minute Trading over on Twitter. Chris has interviewed me on his podcast several times. Great guy, puts out good information. So please support him at 10 Minute Trading. Let's see what Chris has to say today. Over the years, I have found that trading isn't so much about what you know. It's more about how you behave. And behavior is hard to teach, even to really smart people. I would say, especially to really smart people. So let's break this down. Over the years, I have found that trading isn't so much about what you know. Listen, I know how to trade. I know all the rules. I know them. I could do them in my sleep. But whether I follow the rules or not, that's a different story. Yes, I know exactly how to trade. Do I follow my rules? Most of the time, but we're human. Sometimes we don't follow. So it's not about what you know, it's about, do you follow what you know? Like he said here, it's more about how you behave, and behavior is hard to teach, even to really smart people. In my experience, the smarter a person is, the less likely they are to follow the rules. I hate to say it. People have asked me, who would be your favorite if you had a trader apprentice? Who would it be? I said, if you had somebody from Yale, or if you had a guy that just, a young man or a young woman, like right out of the Marines. Well, I would take the person out of the Marines, because they know how to follow rules. Smart people get up in their heads and go, yeah, well, this is saying this, but if I look at the macroeconomic situation, I think it's different. Well, I get it. I have fallen into that trap too. But after 28 years of trading, I have found that the most profitable way to trade is just to follow the price action of what's going on. Not what you think should happen, but what is happening. That is the key. So the takeaway here is, learn a trading approach using good trading principles, whether it's mine or someone else. And if it's good, it should position size for volatility. You should have a very good risk to reward ratio, and you should know exactly what you're going to do in the trade, regardless of what the market does. That's what you need to do. That is what you need to do, not what you think is going to happen. All right. So get that process, follow that process, regardless of what you think the market should do. The only important thing is what the market is doing, and that's why you should have that process. Thank you, Chris. Please follow Chris over at 10 Minute Trading. Let's do a quick poem from my friend Frank. You can follow Frank over at Frank OD. Great poet, great musician, great journalist, and always writes a good poem pertinent to what's going on. Let's see what today's market poem is from Frank. No trader is going to catch them all. Those home run hits that fly over the wall. They say the best profits come between a stock's rise and fall. The key to good trading is keeping your eye on the ball. Let's break it down. No trader is going to catch them all. That's true. You're just not going to win every trade. Casinos don't win every bet, deal of the card, roll of the dice, roll of the roulette ball. They do not, right? Usually about 52, 53% of the time. That's where their edge is. It's same in trading. You're not going to catch them all, but if you use good trading principles and have an edge over the long run, you will make money. Those home runs hit that fly over the wall. Nice to have those. They say that the best profits between a stock's rise and fall. Well, that's true, right? Swing trading. The key to good trading is keeping your eye on the ball, and keeping your eye on the ball is just a metaphor for following your process. Thank you so much, Frank. Appreciate that. Please follow Frank over at Franco D. All right. As I discussed at the beginning of the podcast, these are the trades that I'm looking for next week. They're not where they need to be yet, but if they get there, I will consider taking the trade. Here is Amazon. All right. Well, we are below the 200-day moving average. That is now acting as resistance. If Amazon bounces, or in other words, bumps its head up at the 200 and can't get back over it, that's a sign that there are no more buyers above that level, and I will get short. In addition to a rejection of the 200, or it could go above the 200 during the day and then close below. That would give me a good risk to reward ratio for a short. I really like the idea that the 200 here dovetails with this big down bar. This is a big down bar larger than 1 ATR, showing that there probably was some distribution here by the fact that it was larger than 1 ATR and down. If we rally back up into halfway of this bar, there's some inherent resistance there. I like how that dovetails exactly with the 200. So if we reject the 200 next week, I will consider getting short Amazon. I'll position size, I'll place my emergency stop 2 ATRs below, worst case scenario, and then if it closes above the 200, I will simply get out of the trade. Now, I like to look at multiple time frames. So the trading time frame on this daily here as at the 200 for the reasons I discussed. Place the green line here. Let's look at the higher time frame on the weekly and see where that line lines up. Well, it lines up on the weeklies right at halfway of the bar. You see how we need to look at multiple time frames to look for resistance on multiple levels. The resistance on the daily is at the 200, as I discussed, inside of halfway of this big down bar. That's the confluence on the daily. The line, the green line, if we look at the weekly, dovetails at halfway of that big down bar, and also the 50 SMA above as resistance. So that is a potential short position that I'm considering for Amazon next week if we reject the 200. Now, if it rejects and then closes all the way down here, then I'm not going to get in the trade because now my risk to reward ratio is not good. But if it does, let's say Monday, go a little bit above the 200 and then close slightly below it, then it gives me a good risk to reward ratio. So that's what I'm looking at next week for Amazon, is a short with a rejection of the 200. Etsy. Wow, I have been talking about Etsy forever. Look at this. Look at this loss of the 200 and then just this huge leg down. If you were long this, you should have got out under the 200. It would have saved you a lot of grief. But now we are getting to some key levels. We're at the negative third ATR channel. 92% of prices stop going down at the negative third ATR channel, move sideways or go up. So that kind of gives you a high overview of, we are in that area where we could have a bounce, but I still need a valid signal. What is my valid signal? Well, the valid signal would be a close back over the 30 RSI. We are currently at a 29.51 RSI. So this is a no-go zone area for me. Yes, it did reject the negative third ATR channel, but not enough to take the trade. I will need this to close above the 30 RSI, a nice gradual close, probably somewhere between 30 and 35 RSI. If it's above, if it has a big rally on Monday and it gets to a 40 RSI, I won't take it because my end of day stop is a close under 30 RSI. And if it's at 40, well, then that's too much of a risk. I need a good risk to reward ratio. So next week, if it closes somewhere 30, 34, 35 RSI, I will consider taking the trade. All right. Alphabet, Google. All right. Google is kind of stuck between the 300 SMA above and the 250 SMA below. I don't want to buy this right here, right now, but if Google comes back down to the 250, see the 250 level here? This is a key level. Look, last time it rejected it, went up. Last time it rejected it, went up. So that is a key level. If it gets there, I will consider entering long Google with a bounce at the 250, an intraday rejection of the 250, or a close under and close back over the 350. So I marked the 250 line here with the green line. Let's go over to the weekly and see if there's any support there. Yes, look, on the 50, on the weekly, do you see how the 250 on the daily dovetails with support at 50 on the weekly? That's what I'm talking about when I talk about multiple confluences of support on multiple time frames. The level on the on the daily is the 250. The level of support on the weekly is the 50, and they both line up. So that's what I'm considering for Google on next week is rejection of a bounce, an intraday rejection, or a close under, a close over the 250. Intel. Okay, this is the level that makes sense to me, the 200. Now, it's not even really close, right? We're at 30.99. That level is 29.15. So I look at this chart and I say, okay, what level am I interested in? Well, the 200 is always an important level. So I just have to be patient. Next week, if for some reason we come down, bounce, reject the 250 or have a close under, close over, then I will consider getting in the trade. If it doesn't get there, then fine, I will just move on to another market. But that's really the key. On the weekends, I do this for the podcast. I identify these levels and go, what makes sense to me? Well, this 200 makes sense to me for a lot of reasons because last time it closed under and closed over, it worked out well and it's holding above there. So next week, if we get there, I'll take the trade with the rejection of the 200. If not, I'll just move on to another market. But I know this sounds simple, but look on the weekends, just look for the level and go, where would I be interested in buying? This is where I'm interested. So great. If it gets there, I take it. If not, I trade another market that it did get there. Make sense? Dollar. All right. This is a little bit different trade here. The key to the dollar here, see where I have the highlighted blue? This is called an abandoned baby. Funny name, right? Why is it called an abandoned baby? Because this particular bar had a gap to the left. See how there's no overlap? There's this big gap to the left and a gap to the right. That it's just kind of abandoned down here. This is a very bullish position in a very bullish structure. And you can see as soon as that happened, it did move up. Now, if it comes back down and touches the high of this abandoned baby and rejects it, that is my entry point. My stop, my emergency stop is always going to be 2 ATRs below. My end of stop will be just a close below here. Let me show you. Look at this abandoned baby, this bearish abandoned baby. Oops, sorry. I'll show you the strength of these signals. Look at this abandoned baby here. Gap to the left, gap to the right, but to the downside. Boy, did that nail the top. Did that not nail the top just perfectly? Well, here we have the dollar down here with a bullish one. These are very, very strong signals, everyone. So kind of the bad news on the dollar here with this abandoned baby is a strong dollar is not good for the market right at this moment. So I am actually bullish on the dollar because of this abandoned baby. Now, I'm not going to just rush in and buy it. I need to wait for my signals to trigger. My signal here would just be a rejection of this high of this abandoned baby. And if it does reject it, I will get long the dollar. And the day stop close below the low of that abandoned baby, because then that neutralizes and undoes the signal. Exxon. All right, Exxon. Well, without me saying, what do you think is the level that I'm looking for? That's right. It's the 200-day moving average. I talked about Exxon all the way up here. And I said, hey, if Exxon gets down to the 200, that's the key level, because there should be some buyers coming at the 200. I had someone message me and said, well, it's almost impossible. It's so high that it can get to the 200. Well, maybe not. Look at this move down. Huge move down. Money coming out of Exxon. So here is my level, 104.50. I drew the line. On the weekly, the 200 on the daily dovetails with the green line, dovetails what kind of support on the weekly? -1 ATR channel. Dovetails perfectly at the -1 ATR channel. So that's what I'm looking for on Exxon, is a bounce at the 200 next week, an intraday rejection of the 200 next week, or simply a close under and close over, giving that 200-day moving average is my line in the sand. And of course, if it does reject and I do take the trade, position size based upon the volatility, place my emergency stop 2 ATRs below, my end of day stop simply a close under the 200-day moving average. To the upside, I'll place my 1.5 ATR trailing stop above. If it starts to move up, I will take partial profits. And then there's all sorts of other rules as far as if, we move up and we get to a 65 RSI level, then the 5 EMA comes into play. If we reject the 70 RSI level, sell half. And then if I have a close below previous bar's low after rejecting the 70 RSI level, then completely out of the trade. But again, this is what I teach in my private one-on-one lessons. I know there's a lot of rules, but look, trading's not easy, and you have to have a lot of rules. And if you do work with me one-on-one in my private lessons, I promise you I will teach you everything step by step, and you will know it like the back of your hand. All right, so just a quick recap on the dailies. Amazon, I am looking for some kind of rejection of the 200 to get short next week. Etsy, I'm looking for a close back over the 30 RSI to get long. Alphabet, Google, looking for some kind of rejection of the 250 to get long. Intel, looking for a pullback to the 200-day moving average to get long. Dollar, looking for a retest of this abandoned baby to get long. And Exxon, looking for a bounce rejection, intraday rejection, or close under, close over of the 200. Now look, these are 6 symbols on the daily. Hypothetically, Monday, all 6 could trigger. Does that mean I'm going to take all 6? No. I have a rule where I only take the best trade of the day. I don't care if I have 6 of them that trigger. I'm only going to take the best one. And what's going to qualify as the best one? Which one has the best risk to reward ratio? Which one has the most confluences or combination of indicators lining up on that particular day? Which one looks the best on the weekly time frame, right? I have entry triggers called V1s and V2s. It's probably a good time for me to discuss this, but that's one of the confluences or combinations of indicators, and V1s, V2s are a huge part of my trading. In my YouTube channel, in the lessons playlist, you can, and actually also in the description of this YouTube video, I have a link, V1s, V2s. Go and watch it. It's totally free. They're great confluences. They add bonus points to any trade. So watch that. I'm sure it will be helpful for you. All right. So those are the potentials that I'm looking at for next week. I want to point out, everyone, this is a channel that I follow on YouTube, Game of Trades. I really like this. You probably, if you trade a lot, you're probably familiar with it. I watch this channel all the time. This particular uh, YouTube video, S&P rally poised to fail at this major resistance levels, like all historic market breaks. This is a very interesting video, and I would suggest that you watch it. Just Google Game of Trades, or YouTube Game of Trades, and SP rally poised to fail at this major resistance level, like all historical bear markets. And in this video, uh, these trend line channels that he has drawn here happened in 1970. Look at this. And he'll explain how he sets these up, but this is just the final result. But he takes these lows, here's the slope of that line, he adds them on top, exactly the same slope, and look, right when it got to that slope, look what happened in 1970. Same thing for 2000, had the big slope down market, he duplicated that line to the upside, when it got there, rejected it, huge crash down. Well, look, we are exactly there right now, everyone. He took the slope of these two lows, he duplicated the slope up here, connected to the top. We are right there. It doesn't mean we're going to have a huge crash, but this particular pattern nailed it in 1970, nailed it in 2000, and is it going to nail it in 2023? I don't know, but this is, I think it's like a 10-15 minute video. It really did have an effect on me, so that's why I wanted to share this with you. And you can follow him over at Game of Trades as well. But I think it's very important. I think it's worthwhile watching 10 minutes of this. So just wanted to share that with you. Okay. All right. Let's get to the weekly, shall we? Okay, these are weekly trades. These are based upon the close on Friday. All right, this is Boeing. This is a potential long position. One of the strategies that I teach in my one-on-one course is called a return to value. The green lines here, here's the top green line, here's the bottom green line. This is called the 1 ATR channel. This is called the negative 1 ATR channel. Anywhere in here is considered the value zone. And return to value, one of my very, very favorite approaches, I learned this from a trader called Kerry Lavorne, is buying. You don't want to buy above value. I rarely buy anything above value. I want to buy in value, sell above value. Buy below value, sell in value. Well, the key to this setup is that first you need to be in an uptrend. You need to be above the 1 ATR channel. Then you need to come back into the value zone. Then you need sideways motion, and then you need a V2 in this case. V2 consists of 3 bars. Bar 1, bar 2 going below the low of bar 1's low, and then closing above the close of bar 1's close. Well, we have a lot of the setup here. We're above the value zone. We came back into the value zone. We have sideways motion showing there's some equal buying and selling, that there's some support. But the trigger for this trade, for me, potentially next week, would have to only be next week, would be a close back above bar 1's close. Close is 206.78. So next week, if we close above 206.78, that would be a return to value, sideways motion, and then a V2 trigger. But this is for next week only. If we close above 206.78, that is my potential for return to value V2. Anheuser-Busch. All right, all sorts of drama going on with Anheuser-Busch, but what am I looking for? A pullback to the 200-week moving average inside the value zone, by the way. Okay, so I don't know if it's going to get there. If it does get there, it's inside this big bar here, which I like. This is a big strong bar up here. We've held inside this big bar. That's the confluence to the rejection of the 200-day moving average. So next week, if we head down, a bounce of the 200, I would potentially get long Budweiser. If we have an intra-week rejection of the 200, I would also get long Budweiser. So that's what I'm looking for. It's about 62.20. We're 64.83. Does it mean it has to go down there? Certainly not. But if it does and gives me a good risk-to-reward ratio, then that's my potential long for the weekly on Budweiser. Pfizer. All right, well, I just got long Pfizer on the daily, as I mentioned. Whoa, whoa, whoa. I, oh, yes, yes, sorry. All right. I got long Pfizer with the rejection of the 30 RSI. Now, next week there are some other potential levels here. If I was not in this trade and we closed above the 200-day moving average, that would get me potentially in. We could also on the weekly go down and reject the 300. I bought it here because the under 30 over 30. Okay. If it closes under 30, I will get out of the trade. However, if it goes down, rejects the 300, then that would be another reason for me to get into trade. So this is a good example of maybe one trade following another. So next week, hypothetically, if we go down, reject the 300, close back above, but it's still under the 30 RSI, I would consider staying in the trade. Does that make sense? I bought because it's an under 30 over 30. So if it closes below the 30, and doesn't reject the 300, I will get out of the trade. However, if we go down and actually hit my stop was at the 30 RSI, but it rejects the 300, I would consider staying in the trade. So if I wasn't in this trade and next week we go down, reject the 300, I would certainly consider this. And you can see Pfizer has come down a tremendous amount. Is it due for a bounce? I would say so, right? But I'm not just going to blindly go in. I need a signal to tell me that. Well, the signal that I took on this week's trade was under 30 over 30, but I'm just saying next week, if it rejects the 300, but it's still under the 30 RSI, I would consider. So to make this simple, if I was not in the trade now with the 30 and it went down and rejected the 300, I would consider taking the trade there. Tesla. All right. Well, Tesla had a bit of a pullback. I really like the 250 SMA right here on the weekly. That would make a lot of sense. It's inside of this big up bar over here. It may just continue to go up, and if it does, great. If you have Tesla, very happy for you. But if it does come back down next week and reject this 250, I will consider getting in the trade. I drew the green line here. Let's look at the weekly. Any support there inside of this big bar here. So multiple support levels, both on the weekly at the 250 and inside the big bar on the daily, which is a confluence for me. All right. So only interested in buying Tesla if and only if we reject this 250-week moving average. Natural gas. Well, natural gas, my gosh, look at this move down. Incredible. How low is this going to go? I don't know. But I have to look at my levels. We're at a 30.09 RSI. If next week we go under 30 and close back over the 30 RSI, I will definitely consider getting in the trade. We also have a double bottom and a bullish divergence. You might ask, what is that? Again, this is something that I teach. This is one of the strategies that I teach in my trading, in my one-on-one trading course. Look at the low here. See how deep these red bars are? These are MACD bars. These are momentum bars. It's showing a huge amount of momentum to the downside. Okay, then we rallied a little bit into some green bars. Now look, we are lower here than we are lower here, but you see how there's not even any red bars left? This is called the double bottom bullish divergence with the missing right shoulder. It essentially means the second move down here is running out of momentum. And if you run out of momentum, essentially you're running out of sellers. Even though it's going down, you are running out of the momentum, the oomph of the move down, and that's indicating a potential depletion of sellers. And if you run out of sellers, you're going to go up. So double bottom bullish divergence, missing right shoulder intact, but I still need a valid entry signal. The valid entry signal would be an under 30 over 30. VIX, woo, lot of drama with VIX. We had what was that? Back during the banking issue, we had a huge move up to $62, $61.20. Now we're at $38.75. I mean, huge volatility crush, but also same with natural gas, double bottom bullish divergence. Here we have a low, deep red MACD bars. Now we are certainly lower here than we were over here. No red MACD bars, double bottom bullish divergence. That is a good big picture high level setup, but we still need the trigger. What is the trigger? Well, it's 32.72. I need an under 30, over 30, to get long the trade. All right, so just a quick recap. Boeing looking to get long next week if we close above 206.78 with a return to value V2. Anheuser-Busch looking to get long if we reject the 200 next week. Pfizer, I already am long based upon the under 30 over 30, but a new signal might be a rejection of the 300-week moving average. Tesla looking to get long if we have a rejection of the 250-week moving average. Natural gas looking to get long if we next week if we have an under 30 over 30 on the RSI. And VIX looking to get long with an under 30 over 30 RSI. All right, so I hope that was helpful. I did want to point something out. I just mentioned I showed you that video from Game of Trades about hitting that really important resistance level with those duplicated trend lines. And it does make sense to me what he's saying, because if we look at the Qs on the daily bar, there's a lot of, this looks very strong, right, with this huge move up on Friday. But let's try to be objective and let's look and see what is going on the Qs on the daily. Well, look, this looks very bullish, but big picture, this looks bearish to me. This is called the double top with the bearish divergence. See the previous top we had here? Look how high the red MACD bars are. This is showing a lot of strong momentum. Well, look at this now. Are we higher here than over here? We are. Are green MACD bars supporting that thesis? No, they are not. We are higher here than over here, but there are no green bars whatsoever. This is showing that we are running out of upward momentum to the upside. We're running out of buyers from a MACD perspective. This doesn't mean you go ahead and short, but looking at the VIX, do you know how we had the double bottom with the bullish divergence? Well, this corroborates the VIX's charts and structure, the reverse of that, with the Qs being higher here than we were here, but no green bars whatsoever. This is bearish. Look how high we were over here. We were at the third ATR channel here. This is the third ATR channel. Now we are higher. We're at like 1.25. These are divergences. Look at the RSI divergences as well. Look at the high here. Look how high the RSI was. Now we're higher. It's lower. This is a triple convergence of bearish indicators. Double top, bearish MACD divergence. Double top, bearish ATR divergence. Double top, RSI divergence. So it makes a lot of sense why the VIX is the opposite of this and showing bullish. Makes sense why the Game of Trades video that I highlighted is showing that we are at a major resistance level. You know, speaking of VIX, I believe it was Friday, someone made a $5 million bet on the VIX on a call. VIX is around, I believe, $20. Don't hold me to that. The index. He bought $90 out of the call options. I don't know if you're familiar with options, but basically it has to go up 300% from here. And he bet $5 million as an undisclosed buyer. I believe that's 50 cent. 50 Cent made over $1 billion buying VIX prior to COVID. So not saying that we're going to have a crash, but what I'm saying is from a technical standpoint, based upon what the VIX is doing, from a being a bullish structure, Qs being a very bearish structure. I mean, we could continue up. There's no doubt, but these things are in place. So please keep that in mind. As always, be careful with your trading. But where we are technically on the Qs vis-a-vis the VIX, vis-a-vis what I mentioned on the dollar, we could be nearing a major high. All right. So, you know, I mentioned through the podcast that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I have taught students from all over the world. I have been trading for 28 years. I really enjoy teaching. I love teaching new students what I know and the 5 different trading approaches. If you are interested in learning a new skill that you can make a living with for the rest of your life, hopefully, right? Not guaranteed, but using the good trading principles, you should consider taking my one-on-one course. It's 15 hours, 5 sessions. Each session is 3 hours. I teach you step by step all 5 of the trading approaches that I use. It's very important to me that my students succeed, so please consider it. It's an investment. The course does cost $1,750, but I promise you it is worth every penny. And if you spoke to my other students, you would realize that. So if you are interested, please send me an email. I will reply, say, hey, thanks for reaching out. Let's set up a Skype call, get to know each other a little bit. The call is free. I promise you it's not a sales call. I just want to learn more about you, your trading, your challenges, your trading challenges, and your goals. It's a great time for you to ask me any specific questions about the format of the lesson. And when we're done with the call, then it's all up to you. If you're interested in the future, just email me back and we'll set up the time and the date and we'll get started. And I know you'll be happy that you took the course. I mentioned this before too, but I have an online course available at udemy.com. It's called the Deep Dip Buy Stock Trading Approach. It's a very, very good course. 9.5 hours of video, 26 videos total, 15 study guides. I teach you step by step how to trade the deep dip buy approach. A lot of the signals that I've been teaching in this course are deep dip buy, and it's affordable. It's between $12 and $16. So consider that. I know you'd be happy that you took it. If you like today's podcast, I really would appreciate it if you could hit the thumbs up button. It helps to build the channel, helps keep the channel around, lets YouTube know that there's some valuable content here. So if you found anything helpful here today, I would really appreciate it if you could just go ahead and hit that thumbs up button. And then last but not least, always most important, please try to go out and do something nice for another human being today. If we all did one nice thing for another human every day, the world would just be a better place. I think it makes sense, right? And if on top of that, if I could ask you one more, please try to go out and do something nice for an animal as well. They appreciate acts of kindness. I grew up with animals. I'm very close with animals, and they appreciate it just like we do. So if you could, one nice thing for another human being today, one nice thing for an animal today, and it really would make the world a better place. So I hope you have a good rest of your weekend. God willing, I'll be here next week and go over the trades, some of the current trades I have and the new trades that I took on Pfizer, and we'll see how things work out. If you have any comments or questions, please leave them in the comment section. I'll do my best to get to them. And other than that, be good, be safe, have a nice weekend, follow your rules, and I just appreciate you being here. Thanks a lot, everyone, and on the way out here, I have to run the U.S. legal disclaimer. Thanks again. Take care. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.